Hi everyone, in this video we are going to continue with our introduction and simple exercise and explain in this particular case why we are adding any increases in current liabilities. As I mentioned, we are going to have the same exercise with little twists. The company is buying $2,000 worth of goods and selling them for $5,000 in cash, no taxes. When we just look at this statement, we are going to realize that the company is not paying anything for the goods they are buying. They are buying it on credit. They will pay it later and selling them for cash. So the cash out inflow is going to be $5,000. We do know that. Now, how do we calculate it? Revenue is going to be $5,000, and the cost of goods sold, regardless whether it's credit or cash based, is still going to be $2,000. So our net income is not changing. Since we are starting with net income, we are going to start with $3,000. And in this case, our accounts payable is increasing in the amount of $2,000. Any increase in current liabilities is going to be added back. So when we add that back, we find out that the change in cash is going to be $5,000, just like we calculated here. You know, they are getting $5,000 cash and they are not paying for the moment for the goods they are buying. Since we are starting with net income, and since net income in this case includes a cost of goods sold that we haven't paid, which increases current liabilities, that's something we need to add it back, and that's the reason why we are adding current liabilities back. Let's look at a different scenario where a company is buying goods for $2,000 credit and selling them for $5,000 credit. In this case, there is no cash transaction, so the change in cash needs to be zero. Let's calculate the revenue. Is $5,000. Cost of goods sold is still $2,000. Net income, assuming no taxes, is $3,000. Cash from operations, we are going to start with net income. As I mentioned earlier in the video, any change, any increase in current liabilities is going to increase cash because we are not paying that cash and we are starting with net income. Any increase in accounts receivable or any current asset is going to decrease cash, and in this case accounts receivables and current assets are increasing in the amount of $5,000. When we add them up, we are going to find pretty much the same answers. The change in cash is zero. Everything is done on credit. The purchase is done on credit. The sale is done on credit. So there is no change in cash. Our net income is $3,000. And since we are starting with net income to calculate cash flow from operations, we need to make adjustments. And as I demonstrated here, any increase in liabilities is going to increase cash because we are not paying and we are starting with net income, and any increase in current assets is going to decrease our cash flow. I hope this helps with the what we call the indirect method. In the next video we are going to start analyzing a full example with a full balance sheet and income statement. I just want to make sure that you understand why we are adding depreciation, why increases in current liabilities are added in, why increases in current assets are subtracted from cash flows.